Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 7th of January. I'm Daniel Lam, your host for the podcast. Now, a number of the providers out there have stated that the 4.5% level for the US 10-year government bond yield is the key level to watch out for, i.e., a sustained period above that level may pressurize risky assets. Well, it has been at or slightly above that level since the middle of December 2024, and that has taken some steam off the US equities rally. So, the question is this a good time to add to US equities? Well, the bulls would point out that the positioning has been declining since peaking in early December last year. Now, in prior episodes of large double-digit equity declines, they were all linked to increasing US recession odds, and therefore downside is probably limited from here, given our core soft landing scenario, and we may see another 2 to 3% decline only in the coming weeks. Seasonal factors suggest that January is likely to be robust, especially when we have a Republican inauguration. Finally, US macro data has remained strong. Now, on the flip side, the arguments against US equities kind of matches the pluses evenly. For example, peak to trough decline in investor exposure level is only half of what historically has been typical, and there's minus 1.3 standard deviation since late November last year versus minus 2.5 standard deviation drop following periods of overextended exposure. Actual declines in the S&P 500 index level have been extremely modest relative to history, with the median peak-to-trough decline of 6.4% during past positioning-led sell-offs versus 2.2% decline now. Flow technicals have been negative, while there has been resilience in the CPI, and we know that the return of inflation, especially from Trump's potential fiscal stimulus, represents a key risk for the markets in 2025. Therefore, investors should be focusing upon the key areas within US equities. For example, there is a good possibility that we can see broadening out from the Magnificent Seven into other areas within the AI growth space, such as those providing service and infrastructure to AI development. These are likely to be steadier plays in the AI investment concept and more defensive in case of market volatility. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.